Silver has a long and storied history. It's not just a shiny metal. For thousands of years, it was real money. Civilizations across the globe used silver to trade. They used it to store their wealth. It was trusted because it was rare. It was durable, easy to divide. You couldn't just print more of it like we print paper money today. This made it a stable store of value. People knew that a silver coin would hold its purchasing power over time. It was the foundation of many powerful economies, ancient Rome, British Empire. The founding fathers of the United States understood silver's importance. The Coinage Act of 1792 established the US dollar. It was defined by a specific weight of silver. This linked the nation's currency directly to a physical, tangible asset. This wasn't a new idea, it was a proven system that had worked for centuries. People had faith in their money because it was backed by something real. You could hold it in your hand. It wasn't just a promise from a government or a bank. It was wealth itself, something you could count on no matter what happened in the world. This tradition of silver as money continued for a very long time. For generations, if you had a silver dollar, you had real wealth. This is a key difference from the money we use today. Our modern currencies are called fiat currencies. They have value only because a government says they do. They're not backed by a physical commodity. The shift away from silver and gold as money was a massive experiment. In the 20th century, governments around the world severed the link between their currencies and precious metals. This allowed for unprecedented levels of government spending debt. But it also introduced a new level of risk into the financial system. The value of our money now depends entirely on the trust we place in political institutions, financial institutions. Silver's long history reminds us that there is an alternative. It represents a form of money that exists outside of this modern system, a store of value that has outlasted every empire, every paper currency. Silver is unique among precious metals. It has a dual identity. Gold is primarily a monetary metal. Most of the gold ever mined still exists, held in vaults as a store of wealth. Silver is different. It is both a monetary metal and a critical industrial commodity. This dual demand gives it a very interesting dynamic. On one hand, people buy silver coins and bars to protect their wealth. This is the investment demand. It grows when people are worried about the economy. It grows with inflation. It grows when the paper money system feels unstable. On the other hand, industries consume silver in vast quantities. Silver is the most conductive and reflective metal on the planet. That makes it essential for modern technologies. You can find silver in your smartphone, you can find it in your laptop, you can find it in the flat-screen TV on your wall. It's used in solar panels to convert sunlight into electricity. It's used in medical devices. It's used in water purification systems. It's used in electric vehicles. Unlike investment silver that gets stored away, industrial silver gets used up. Often the amounts are so tiny it's not economical to recycle. So industrial silver is effectively gone forever. Industrial consumption is not small. It accounts for more than half of annual silver demand. That creates a constant underlying demand separate from financial markets. As technology advances, the need for silver grows. Think about the global push for green energy. Solar panels depend on silver. Electric vehicles depend on silver. Both rely heavily on the metal. So as the world modernizes, demand is set to increase. When you own physical silver, you're holding an asset driven by two forces. Monetary demand from investors seeking a safe haven. Industrial demand from manufacturers building the products of the future. Let's look at some important numbers. The world is changing, and these changes affect silver. First, let's consider supply. Mined silver hasn't kept up with consumption. The Silver Institute shows a recent physical market deficit. Total demand from industry jewelry investment exceeded supply from mine production recycling. When demand outstrips supply, prices rise. Now where is that demand coming from? Industrial demand is the biggest piece. In 2023, industrial fabrication hit a record. This was driven by the green economy. Photovoltaics, solar panels, are huge silver consumers. Solar installations are exploding globally. Solar silver demand is projected to keep climbing. Another big driver is the auto industry, especially electric vehicles. EVs use far more silver than traditional cars. Silver is used in electrical contacts, battery management systems, other electronic components. As electrification accelerates, auto silver demand will soar. This is happening now. Major manufacturers are investing billions. Silver is essential. Now consider investment demand, rising government debt and currency creation. Since 2020, central banks have printed record amounts. That devalues paper money and drives demand for tangible assets like silver and gold. Silver coins bars. A structural supply deficit, booming green tech, industrial demand, rising investment demand together make a powerful case for silver today. The numbers point to a compelling future. Silver's price history is fascinating. It's known for being more volatile than gold. This means its price can move up and down more dramatically. Some investors see this as a risk, but smart investors see it as an opportunity. Understanding silver's past price movements can help us understand its future potential. Silver has had two major bull markets in the modern era. The first one culminated in 1980. The price spiked to nearly $50 per ounce. This was driven by high inflation, geopolitical uncertainty, and an attempt by the Hunt brothers to corner the market. After the 1980 peak, silver entered a long bear market. Its price fell and stayed low for about 2 decades. Many people forgot about silver as an investment. But during this time, industrial uses for silver were growing quietly in the background. The fundamental story was changing. The stage was being set for the next major move. This is often how markets work. The second major bull market began in the early 2000s. It was a slower, more sustained climb. The price rose from under $5 per ounce in 2001 to a peak of nearly $49 per ounce in 2011. This incredible run of over 900% was driven by a combination of factors. The financial crisis of 2008 created huge demand for safe haven assets. The growth of emerging economies like China, India fueled industrial demand. Since the 2011 peak, silver's price has been in another long consolidation period. It's traded in a range, building a strong base. History shows that after these long periods of consolidation, silver's price tends to move explosively. One of the most powerful tools for understanding silver's value is the gold-to-silver ratio. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. It's a historical measure of relative value between the two monetary metals. For centuries, the ratio hovered around 15:1. That reflected the natural abundance of the metals in the Earth's crust. In many monetary systems, the ratio was even legally fixed around that level. In the modern era, the ratio has become much more volatile. It has swung wildly, as low as 15:1 and as high as 125:1. A high ratio signals silver is undervalued versus gold. A low ratio signals silver is overvalued versus gold. For investors, this can be a timing indicator. Buy silver when the ratio is high, then swap into gold when the ratio falls. Today, the ratio is historically high. It's well above the 20th century average of about 50:1. As of late 2025, it's been hovering in the 80s or the 90s. That means 80 ounces or 90 ounces of silver to buy 1 ounce of gold. In other words, silver is extremely cheap relative to gold. History shows high ratios tend to correct. Usually, silver's price rises faster than gold, and the ratio falls back toward the mean. This pattern has repeated, notably in the run-up to 1980, and again in 2011. Given today's high ratio, the potential for a similar move is substantial. Buying silver now is like getting a historical bargain compared to gold. It offers a chance at much greater percentage gains if the ratio reverts to the mean. When most people think about investing, they think about the stock market. Stocks represent ownership in a company's. Their value is tied to the company's future earnings and the overall health of the economy. For much of the past few decades, stocks have been a great investment, but they also carry significant risks. A stock's value can go to zero if the company goes bankrupt. The entire market can crash during a recession or a financial crisis, wiping out years of gains. Stocks are paper assets that exist within the financial system. Silver is a different kind of asset. It is a tangible, physical good. It is a Tier 1 asset, which means it has no counterparty risk. If you hold a silver coin in your hand, You don't need a broker or a bank or a government to make it whole. It has intrinsic value that has been recognized for 5,000 years. It cannot go bankrupt. It cannot be printed into oblivion like a currency. It is wealth that exists outside the conventional financial system. This makes it an excellent tool for diversification and a form of financial insurance. The performance of silver versus stocks tends to be cyclical. There are long periods when stocks outperform silver, like in the 1990s, and there are periods when silver outperforms stocks, like in the 1970s and from 2000 to 2011. We may be entering another one of those periods now. No investment is without risk, and it is important to be honest about them. As mentioned, silver's price can be volatile. It can experience sharp price swings in the short term. An investor who needs their money back in a few months might find this volatility uncomfortable. Silver is a long-term investment, not a get-rich-quick scheme. It is a strategy for preserving wealth, and for growing wealth, over a period of years, not days or weeks. This volatility is a risk for the short-term speculator, but for the long-term investor, it presents opportunities to accumulate more silver at lower prices. Another perceived risk is silver's lack of a yield. Unlike a stock that might pay a dividend, or a bond that pays interest, a stack of silver coins does not generate an income. This is true. However, the purpose of owning silver is not to generate cash flow. Its purpose is capital preservation and capital gains. During periods of high inflation or currency devaluation, silver's capital gains can far outweigh the small dividends paid by stocks. The yield from silver comes from its ability to protect your purchasing power when paper assets are losing value. The biggest risk, however, is not owning any. In today's financial environment, holding all of your wealth in paper assets is risky. We are in an unprecedented global debt bubble. Central banks have engaged in radical monetary experiments for over a decade. The value of every major currency is steadily being eroded by inflation. In this context, the risk of a financial reset or a severe currency crisis is very real. Not having a portion of your wealth in a tangible asset outside of that system is a gamble on the system's perpetual stability. This is where silver shines. It is the ultimate hedge against systemic risk.